So you've done the hard work, you've filed your taxes, and then you see it. You actually paid too much. It happens way more often than you'd think, usually because you had excess tax credits. But the real question is, what do you do now? Today, we're going to break down the simple but super important choice you have to make.
Right, so this is your situation. You've overpaid. And first things first, that's great news. It's definitely a good problem to have. But, and this is key, you have to tell the government what to do with that extra cash. You've got a decision to make. And believe me, it's a bigger deal than it looks.
The good news is, the Philippine tax law doesn't leave you hanging. The rules give you two very clear, very distinct paths you can go down. It's not complicated, but picking the right one for your situation, that's everything.
And here they are, your two choices. On one hand, you have the carryover. On the other, you can go for a refund or a tax credit certificate, which everyone just calls a TCC. Now, they might sound a bit similar, but they operate in completely different worlds.
And for such an important decision, making it is ridiculously simple. You don't need some special form or a separate application. You literally just tick a box right there on your annual income tax return, your AITR. That one little check mark starts the whole ball rolling. Okay, let's dive into the first option, the most straightforward path. Honestly, this is the one that most people and most businesses are probably going to use. We're talking about the carryover. So, what in the world is a carryover? The best way to think of it is like an automatic down payment on next year's income tax. That extra money you paid this year, it just rolls forward and gets applied as a credit to whatever income tax you owe next year. It's clean, it's direct, it's built right in. Now, this is a huge point of confusion, so let's make this crystal clear. If you choose the carryover option, you do not need to apply for a tax credit certificate. That's a totally separate thing for the other choice. For a simple carryover, there is zero extra paperwork. And this just shows you how simple it is. I mean, look at this. Step 1, you take the carryover box on your tax return. Step 2, you file it like you normally would. And boom, step 3, that amount just magically appears on next year's form under prior year's excess credits. That's it. It's such an elegant, hands-off solution. So the real takeaway here is that your filed AITR is the proof. It's the official record and the engine that makes it happen all in one. You don't have to go chasing down some other certificate to prove you have this credit. The return you already filed does all the heavy lifting for you. Okay, hold on. Before you run off and tick that carryover box, we have to talk about one absolutely critical rule. It's called the irrevocability rule, and yeah, it is exactly as serious as it sounds. Let's really look at what this means for you. This isn't just a suggestion, it's written right into the law. Section 76 of the tax code is perfectly clear. It says once you make that choice to carry over, that decision is final for that tax year. You can't change your mind a few months later and ask for a cash refund instead. It is a one-way street. So why is the rule so strict? Well, the logic behind it is actually really simple. It's there to stop anyone from, double dipping, claiming the amount as a carryover credit and also getting it back as a cash refund. The rule makes sure you get your money back, but you only get it back once. Makes sense, right? All of this begs a pretty obvious question. If carryover is so easy, why would anyone ever pick the other option? Well, that's because the tax credit certificate, the TCC, is a totally different tool for a very different set of circumstances. Okay, so a TCC is a formal certificate you have to apply for. The huge advantage here is flexibility. You see, a carryover can only be used for one thing, future income tax. But a TCC, you can often use that to pay other national taxes, and in some cases, you can even transfer it to another taxpayer. But, and this is a big but, that flexibility comes with a price, a whole separate, much more involved application process. All right, let's put it all side by side. Think of this as your ultimate cheat sheet. For carryover, the only document you need is your filed AITR. The process? Automatic. The use case? Super simple, to offset next year's income tax. Now, for a TCC or refund, you need a separate application. The process is manual, and you'd use it if you need more flexibility, like paying other taxes, or maybe if you don't think you'll even have any income tax to pay next year. And that really brings us to the final question you've got to ask yourself. Is your tax life pretty straightforward? Do you fully expect to have an income tax bill next year? If the answer to those questions is yes, then the carryover option is almost certainly the clean, simple, no-headache solution. It was designed to be the default for a reason. So take a look at your own situation. Which path really makes the most sense for you?